Welcome to Galaxy Brains.
An infinite amount of cash.
I'm your host, Alex Thorn.
The U.S. banking system is sound and resilient.
Bitcoin made a new all-time high.
If you're not long, you're short.
Satoshi's going to come on there, laugh hysterically, go quiet. All Bitcoin's going to be erased.
Bitcoin's the best crypto out there.
Bitcoin is going to zero.
Welcome back to Galaxy Brains. As always, I'm your host, Alex Thorn, head of firm-wide research at Galaxy. Bitcoin's not zero, and we have a great episode for you this week. Zane Glauber and Harry Austin from Galaxy's strategic operations team join us to talk about Galaxy's staking operations, trends in staking and blockchain infrastructure, whether we'll see ETFs in the US that can stake their holdings, and much more. It's an interesting conversation that those guys on the Galaxy Strat Ops team doing a lot of interesting work that I know you might want to hear about. We'll also check in with our good friend Beimnet Abebe from Galaxy Trading to talk about markets. It turns out it was not or has not been sell in May and go away. Indeed, equity markets nearing all-time highs, Bitcoin approaching another all-time high, and in general, the risk impulse appears to be back. We'll get into it with Beimnet. Before we get into all that, I need to remind you to please refer to the link to the disclaimer in the podcast notes and note that none of the information in this podcast constitutes investment advice or an offer, recommendation, or solicitation by Galaxy or any of its affiliates to buy or sell any securities. Let's hop right into it. Let's go now to our friend Beimnet Abebe from Galaxy Trading. As always, Beimnet, welcome back to Galaxy Brains.
Thanks for having me.
It's been an exciting time. I say this every time because markets stay exciting, but here we are on Wednesday, July 2nd, heading into July 4th weekend. Bitcoin knocking on the door yet again of all-time highs at like 109.5 as we talk. Stocks at all-time highs, effectively. I mean, made new all-time highs again. Maybe start with the macro and the stocks. I know Trump also likes a Vietnam deal and some other stuff. Like, what is the market broadly? It doesn't seem like it was sell in May and go away. Here we are at the beginning of July, and stocks and markets are up.
Yeah, no, I mean, it's a combination of a couple of different things. The monetary backdrop is really strong and supportive. That's been a function of weakening data and more a function of pressure being applied on Powell to cut rates. And so there's some pretty strong actions that the government can take to get rates lower, and that essentially means like appointing a shadow Fed chair to a new governor's seat, and just constantly deriding Powell in public. So that will probably lead to us cutting rates sooner rather than later. And in terms of current pricing, you have about 65 bips out to December and like 3 full cuts by January. So in essentially 7 months, folks are expecting, the rate market to have come down by 75 basis points, and that's material. And then the other main driver of markets is the fiscal impulse in markets. We just passed the Senate's version of the big beautiful bill that is going to add, anywhere from $3 to $4 trillion to the debt over the coming years. But by and large, it's a ton of spending. By historical context, it's like emergency levels of spending, and yet the economy's doing just fine. So throw in an easy monetary policy with a very strong fiscal backdrop, and you get higher risk markets, and that's what you're seeing here in equities. To add to that, there's still strong momentum behind the AI narrative. So names that are going to benefit from AI becoming a much more dominant part of how folks operate on a day-to-day basis, robotics, analyze data, all of that stuff. Those companies are continuing to perform well. So yeah, and the trade stuff, folks seem to have put less weight on the potential consequences of tariff policy, and so folks are willing to look through a lot more on the trade stuff, just because it feels like yesterday's news, and like people are like, oh, we're gonna have tariffs, and we'll kind of figure it out. So yeah, trade policy easy, strong fiscal, easy monetary, risk markets higher. But there are some pockets that are worth watching, because again, you can't just spend like trillions of dollars and have no consequence to it. And so, we've seen a reasonable, like the yield curve is pretty steep right now, and it looks like it's probably going to go steeper. Uh, FX wise, euro this week touched 118, broke above briefly. So you've seen a roughly 14-15% depreciation in the dollar versus the euro. And so that kind of seems like where the release valve is for markets at the moment. Um, and I don't see that trend stopping. Like we are very adversarial on trade policy, military policy. I think that's up for debate. And then on top of that, we're just printing a ton of money, and so the natural kind of response function to that in the marketplace is that the value of dollars on a relative basis needs to decline, and that is what you're seeing happening in global FX markets.
Yep. So let's talk about the flows on the Bitcoin side, because obviously Bitcoin getting a bit of a bounce, or at least supported by a supportive risk environment, but also huge flows. I saw CoinDesk reported that the public Bitcoin companies have taken in much more in capital than the net inflows of the Bitcoin ETFs in Q2. Is that what you're seeing? And is the rise in Bitcoin we're seeing at the moment, is it these publicly traded treasury companies in the market?
Yeah. So, in terms of the flow analysis we've done, there's been about $20-ish billion worth of buying between these publicly listed, treasury vehicles and the ETFs. And I think the ETFs account for, like $1.5 billion of Bitcoin inflows. But the story is pretty clear. You're talking about, net buying in the ballpark of $20 billion,
Year to date.
from year to date from known vehicles, and you're talking about Bitcoin supply that's call it $50-ish million, per day, in sell pressure. I think it's probably a little bit less because some of these miners keep their BTC balances, but when you break down that 20 billion number, you're talking about like an imbalance, that's around like 70 million bucks of net buying pressure per day, which is a lot for any market to absorb. But ultimately, over time, if these trends persist, that does mean that Bitcoin will be at all-time highs much sooner rather than later, and especially with this supportive risk backdrop, the debasement, fiscal narrative, staying strong and getting stronger by the day. In fact, I think that's going to bode well for crypto, and then away from the flows, you're seeing a regulatory landscape that is unprecedented for crypto. The approval process for ETFs, getting faster, tokenization of equities, increased issuance of stablecoins, right? And so we're finally starting to see the wheels of government actually, supporting crypto, and over time, I think that should help crypto price appreciation XBTC, simply because it's a narrative that a lot of folks can latch onto pretty easily. Now, there's still some doubt over the value accrual that happens in kind of non-Bitcoin area. But by and large, when you have all these constructive developments, it should really kind of keep the narrative alive and well. And as long as there's a healthy backdrop, I think that could lead to price appreciation.
Well, there you have it. Our friend Beimnet Abebe from Galaxy Trading. Thank you so much.
Thanks for having me.
Let's go now to our guests, Harry Austin and Zane Glauber from Galaxy Strategic Opportunities Team, also known as the Blockchain Infrastructure Team. Harry and Zane, welcome to Galaxy Brains.
Thank you very much.
Thank you, Mr. Thorn.
We've got the three-person interview. We don't do this setup very often. I think the only time I've done it was with Mike Novogratz and Dan Moorhead, so this should be an equally exciting episode.
We would hope.
Let's talk about, we're going to talk about staking. We're going to talk about new regulatory changes and catalysts that are making it more palatable or exciting for institutions to come into staking. And then also just like what other blockchain infrastructure things there are, what it's like to, how hard is it to run one of these Solana nodes? I hear it's a big pain in the ass. Is that true? What does the future of blockchain infrastructure look like in your mind? How is Galaxy positioning for it? I don't know. Why don't we start saying we were talking about earlier? We were talking about this new guidance from the SEC that says that staking as a service, that service is not a security. They had sued, the SEC under Gary Gensler had sued Coinbase and Kraken both, saying that their staking as a service program itself, the program, was a security offering. The SEC now under Chair Atkins says, no, it's not. What did they say, and what does that mean for staking?
Yeah, sure. So absolutely critical watershed moment after many years of advocacy down in DC, a lot of institutional, industry groups, et cetera. But yeah, the punchline is exactly what you just said, which is the thoughtful, legitimate provisioning of staking services is indeed ministerial, and therefore not security-like or is a security. So gone are the yesteryears of enforcement actions and all that other stuff. It's a complete 180, and frankly, really good for institutions who I think have very much been. This is, tale as old as time, but very much have been waiting on the sidelines before deploying a meaningful amount of capital into staking and also the provisioning of staking services on their platforms. So that's massive. But I think what's really interesting is if you read, the letter penned by the SEC, they also roped in or ring-fenced some ancillary services around the provisioning of core staking services, which included slashing insurance, the early unbonding or instant liquidity product, also the modification of the rewards streams, and also they call it the aggregation of core stake. It was called pooling in a prior paradigm, which again was like very much targeted in terms of enforcement actions, but now deemed not security-like. And I think that's really critical for a lot of the folks who are thinking about, increasing the utilization ratio, while not only just incorporating core staking into the spot ETF to make it a total return type product, but also taking that stake ratio, that utilization ratio from 0 to 50 maybe as a starting place, and then optimizing from 50 all the way up to 100, using things like an instant liquidity product to help manage the asset liability mismatch or the liquidity mismatch of locking and staking versus any underlying redemption flow in the fund. So very exciting time. It's all happening, and I said this before with you earlier, but one indication that we look at in terms of just a groundswell of staking activity is the Ethereum activation queue. We are now north of 7 days. It ballooned out to like 45 days or something like that post-merge. Last time we saw this level of activity was April of last year. And so I think that shows that people are voting, frankly, with their stake. There's a lot of new entrants in the market. A lot of Ethereum is being staked. And I think we're excited for what's ahead. This means probably the proliferation of hopefully staked ETP and ETF product here in the US, but then also maybe the proliferation of TradFi platforms incorporating staking into the user experience.
Yeah, I was just going to add, like, kind of what Zane touched on at the very end is one of the most interesting things I think we're going to see unfold in the next 12 to 18 months is I think we'll see the market completely change in who is actually staking, where are staking services even available. Generally, what we've seen with the traditional player, the traditional financial players is they start with spot, right, outside of the ETF complex, start with spot, move to staking, move to LSTs, and then maybe, dabble in the DeFi space. That's generally what the ARC would imagine. We're somewhere between spot and staking, and so I think you're going to see a lot more major traditional names being a distribution channel for staking services. And then I think the actual stakers themselves, the composition of those and counterparties is also going to change. So I think the research will be really interesting to see how that moves. And then from the business side of the house, this is where, I think it's going to be the most exciting 12 months for us. And hopefully we get some guidance here on liquid staking tokens as well.
Yeah, that was excluded from the SEC's guidance,
sure
right? What do we think about that? Or do you think? I mean, we know we're not the SEC, and none of the three of us, I believe, are lawyers. But is it because it's like maybe it's not purely ministerial? Maybe the entity that's doing the wrapping on to make the staking token liquid, maybe they are entrepreneurial in their capabilities of actually doing the underlying staking? Is that, I mean, that's what comes to my mind as a reason why maybe it was excluded for the time being.
I think there's probably more of a practical reason. This is just my personal take, is walk before you can run a little bit. Get the guidance out for physical staking, which is the native protocol use of the blockchain and the whole incentive structures, and then move to the more eloquent, capital efficient structure, which is an LST. And I think we'll see. Hopefully, we see some guidance come in the near future, and then once that comes, I think you'll see an even a larger shift in the market itself.
That makes sense. I think walk before you can run makes sense. I think all of those guidances we've seen, mostly from the corporate finance group at the SEC division, has sort of been like picking off low-hanging fruit, right? Like they said, mining pools. If you submit hashes to a mining pool, like that's not a securities relationship. Like I think most people knew that, but like they're just, one by one. They said meme coins, if they're literally just meme coins, probably not a security. Right. So I think that makes sense. We talked about the ETFs. When are the ETFs going to have staking? I mean, you have Ethereum ETFs, ETPs in the U.S. They could stake today. Mm-hmm. You don't quite yet have Solana ETPs, but it sounds like they're coming. When do you think the SEC will get over this hurdle and let them stake? I
think I saw last week there were some comments back from the SEC to a number of filers. I don't have a great prediction, but I'm hoping some portion this summer or maybe early fall will get one of the first ones to do it. Europeans are obviously ahead. There's a lot of staked ETPs in the Europe complex today, and they're actually paving the way for how to structure these. Structuring is actually probably one of the most critical components of any staked ETF, only because you have the liquidity mismatch based on the structure of the chain on entry and exit queues. People really need to make sure that they can meet the redemptions. And so there's a lot of discussion, and I think you were involved with some of this, and around how should regulators think about how much what's the percentage of assets that can be staked?
Right.
We have products in our product set that help bridge that liquidity gap, and I think you're seeing a lot of innovation in servicing those asset managers who are trying to structure the most efficient and best products, and it'll be very interesting to see what percent of stake these allocators are targeting and how that all unfolds.
Do you think it's going to be distributors like ETF providers or big asset managers that pool the capital? Are they not going to just run the staking themselves, or is it too complicated, specialized? And I guess stake on most networks has native delegation so it's quite easy to actually just use a provider and not lose a lot of the economics. But will BlackRock be staking, or will BlackRock always be partnering with a powerful staking firm?
I think my intuition tells me that there's going to be a separation of roles and responsibilities up and down the entire staking transaction lifecycle, right? You've got a core custodial element, right? Part of that is just, frankly, RAA type rules, but qualified custodians that have the correct licensure, the correct security posture, the correct insurance policies, and all kinds of other stuff. So you have assurances around the spot element, right? And you were, kind of hinting at it earlier, like running blockchain infrastructure at scale is very, very difficult. It's in most cases you're using publicly sourced code bases and stuff like that, but you run into unique issues at scale that you can't just, learn in a classroom, so to speak. So a lot of it is experiential. A lot of it, frankly, is onboarding the right infrastructure, technology, and stack, having the right staffing and tooling. It's a lot more difficult than people would, it might look at first blush. And so I imagine that a BlackRock or, massive asset manager or allocator XYZ, for them to also in-house staking might be a leap too far. Focus on the core product and what you do really well, and let the subject matter experts along the supply chain support in doing what they do best.
And it evolves, right? I mean, the code gets updated.
Sure.
And they're all different, right? I mean, you can presumably be a home staker on Ethereum. Can't be a home staker really on Solana, or home validator.
Not a current state. Not current.
How much? We heard this for a long time, and there was
Yeah.
it was very in vogue in like 2020 and 2021 to calculate the level of a proof of stake blockchain's decentralization, partially by how costly it was to run a node.
Right.
How costly is it to run a Solana node?
It depends on the organization. For organizations like ours and our competitors, hundreds of thousands of dollars or $100,000 a year. I mean, it's tough to quantify just because of the engineering. It's engineering time. It's actual hardware. Solana you have to run on bare metal, right?
Yeah.
The vast majority of Solana nodes today are run on bare metal, sitting in data
They're
centers.
not virtualized.
They're not.
Yeah.
You're not cloud based, right? Running a Solana validator.
So you literally got servers. Big-
servers in data centers around the world that you have to have failovers for in multiple data centers. So there's a lot of business continuity that
That's
goes
right.
into
Because if you're
enterprise
selected to propose the next block and your server's screwed up, you just miss it. Or do you even get slashed? Or
yeah, like the business continuity matters. Like let's say you have
but that's money out of your stake, your delegators' mouths, and out of
exactly.
out of
Right.
yours.
But like if
Foregone
you
revenue opportunity.
if you have ISPs go down in let's say Europe, you want to have another setup somewhere else.
Yeah.
Right. Like that. Just general supply chain issues that you get. I do want to go back to something we had the question before because I can play the other side of the card here.
Okay.
I think crypto M&A is going to be very interesting, and I think that you might see. I agree with Zane in the fact that technical talent is a little sparse on blockchain infrastructure SREs or people that are engineers that really know how to run highly efficient, highly profitable blockchain infrastructure businesses, but there might be consolidation that happens where big asset managers and or just big traditional financial institutions say, can't go hire it, can't build it ourselves, we'll buy it.
Yeah.
I think you could see that.
Sure.
But I do believe in the short term, it'll be a lot of third-party providers because it is very specialized.
And it is today, right?
Yes.
It's mostly big third-party providers, the Galaxies and Figments, and I don't know who
Blockdaemon,
Blockdaemon.
Kiln, P2P. There's a number of them in this
but
world.
I've when we've looked at like, what are the big validators on XYZ network, you often see like the same parties, right? Coinbase.
Because they are technically excellent and they have completely covered everything that Harry was just saying, which is it's not just enough to run highly performant blockchain infrastructure. You need to have the support system around it to ensure uptime is everything. Proof of stake is liveness, right? And to extend that analogy further, sure there might be consolidation in all these major asset holders or influential traditional financial firms. However, in the spirit of prudent risk management, there's still going to be an argument to be made for diversifying the cohort of infrastructure providers, right? We think about disaster recovery, business continuity in terms of geographical redundancies and all kinds of other stuff. But still, I think the value proposition of building a really good product at crazy, like billions of scale, then it would probably make sense to not just have one centralized entity running the entire infrastructure for that product.
Right. That makes a lot of sense. But I don't want to harp on Solana's expensive node,
We
although
love Solana.
100K
Let's
a
talk
year is
Solana.
not that bad. I mean, it's out of reach for like a home person, but it's
individual validator.
right.
Right.
One machine, one bare metal.
Plus,
Is it the
oversight,
what is it,
overhead.
bandwidth? I've heard things like that the Solana blockchain produces like the entire Bitcoin blockchain's worth of data per day. Is it storage of data? Do you even store that data or do you discard it? Is it just the speed? You need so much compute because I don't know how fast Solana blocks are. Like
Solana
couple hundred
blockchain is
milliseconds?
400 milliseconds,
Yeah.
right? Compared to other blockchains, that's
Very fast.
lightning fast. And I think the goal was 100 transactions per minute,
Right.
transaction per second.
So is
1
it the
million transactions per
compute?
second.
Like what makes it expensive? Like just the actual hardware
Yeah, I mean, you need high-end hardware that has high compute, right?
with good bandwidth.
With good bandwidth. It's Solana's the Nasdaq of the future.
what they wanna be,
They
right?
want to be that. Solana's the most interesting, one of the most interesting networks that we work with. I think someone said earlier that like running Solana validators is like driving F1. Highly competitive, everyone's tuning, and it's a great network to be involved with, and we spend a significant amount of time in it. And when we talk about the future of blockchains, right, or blockchain infrastructure, we're spending a lot of time talking to institutions, not just on blockchain infrastructure, but like, okay, where are they going to build applications? Where are they going to settle transactions? And where, we hear Solana. We used to hear Ethereum. Now we hear Ethereum and Solana and others as well. But there's a lot of discussion now around Solana really being solidified as the third chain. And it will be interesting to see where, if QSIPs come on chain, where will they settle? I think you probably get them on multi-chain. Yeah, I mean, it's just a little bit easier to understand than, the Ethereum complex with L2s and whatnot.
Yeah, well, and the L2s don't have validators currently, so you're just L1 staking to get that yield. But like, that's one thing I was wondering about, like the L2s, right? Your opportunity as a blockchain infrastructure service provider, can we not? Is there nothing to do on the L2s really? Because they're all just. I mean, no offense to Base, but isn't it just a computer in Brian's basement basically? Like, right? Like optimistic rollups are literally just some computer, one sequencer.
Yeah, well, that's the thing, right? So, what's cool about blockchain infrastructure generally is there is staking and validator node infrastructure. I think that's pretty accessible to those who are in the arena. But as you extend to the L2 space, you've got provers and sequencers. And so we have those in-house capabilities as well. One thing that will be curious to your what you were saying before is like sequencer revenue is a golden goose.
It's a lot of money.
There is no doubt, and it's a great business. But why would one, is there, I don't know this, but is there a lot of pressure on the Base team to decentralize their sequencer? I have no idea.
Yeah.
I'm sure their shareholders are quite happy about them centralizing
I think we
it.
looked, and you can see this on chain, just the fees that the Base sequencer accrues. I think basically on a daily basis in Q1, it's $250K per day.
Yeah.
It's a significant amount of money. I mean, that's,
I would run that computer all day.
$75 million a year.
Yeah, and we'll see if there's decentralization in the L2 space. Right?
Yeah, I don't
know.
Yeah, I mean,
the arc is that it will.
They all claim to be moving to it.
Yeah.
I think, but it feels like, because it feels like they got the application layers deployed, and then most users don't care. They have optimistic rollups, have unilateral exit capability. So it's like, well, if anything goes wrong, I can just submit my transaction on chain and back right out of this thing. So like, why do I care if, while it's not going wrong, it's centralized? I think that's sort of what it is. But you have this trend of, you have Base from Coinbase, you have Ink from Kraken, and you have BuyReal from Bybit, they just announced. There's probably others that let alone like, BNB or whatever that is to Binance. Is that I'm not even sure how BNB is. There's that old joke, like it's a CAPTCHA and it says name all the BNB validators, and it's just CZ in different disguises. But like, right, I mean, this trend of, I guess in this case, crypto exchanges trying to own the stack, get their own blockchain infrastructure platform, their own, not infrastructure, their own L1, their own blockchains. Yep. Even though they're not really blockchains if they're L2s. Is that going to keep happening?
Yeah, I think that's going to persist. I think everyone launched an L2. We're still kind of in that phase, and you'll probably see a bunch more announcements, is my guess, over the next year. It'll be interesting to see that. We've been talking a lot. I think this is the year of institutions, at least in blockchain infrastructure.
Feels like they're finally coming.
They're here,
yeah,
right? And I'm sure we're going to see more announcements of L2s. The question is okay, are we going to have fragmented liquidity? And how is it going to actually what is going to happen
sorry,
next?
BuyReal, I think, is launching on Solana L1, not an L2, actually, which is an interesting differentiator. I didn't just to correct what I said before. But yes.
Yeah, no, and so, if you got major financial institutions launching L2s, then you have to have build applications on them. It's like the stablecoin game today, right? Everyone's launching a stablecoin.
I was about to say that. Everyone and their grandmother is going to have an L-tune and a stablecoin by the end of the year.
Yeah. It does make me wonder, to the pressure on Coinbase or Kraken or any of these L2s to decentralize, it does make me wonder if we get into a space, when you're talking about bringing QSIPs on chain, right? You're talking about tokenized equities, equity securities. I do have to wonder, and I'm not the guy on this, but I have to wonder whether the SEC is going to accept securities market trading on infrastructure wholly owned by one company.
I'd imagine that they have to set some rules in the future around level of decentralization, right? Like,
because that's what they're doing in the Clarity Act. There is a mature blockchain system that is sufficiently decentralized. It doesn't seem like any of the Ethereum L2s would really qualify.
Probably not now. No.
So it's interesting. Crypto is this ebb and flow of like Satoshi maximal decentralization, anonymity, and then it's like we keep flowing in like, well, wait, that doesn't let us do a lot, so let's centralize. And it's like, well, wait, maybe that's bad. We should re-decentralize.
It's somewhere in the middle, I think, is the right answer.
Yeah.
Right.
Yeah, and let's face it, like economic interests will only promote centralization until such time there's probably a bigger need to evolve, which would likely be from a regulatory bent, at which point they have to settle for 1/5 the revenue to spread it 5 ways. And that should be okay to the extent they want their L2 to be the venue over which all these things, trade and settle.
Let's talk about governance a little, because there was an interesting thing that we worked on here a couple months ago at this point. SIMD 228, the Solana inflation.
The infamous one.
Yes, it was a little contentious in the Solana community.
Sure.
Inflation reduction proposal pragmatically would have reduced Solana emissions going forward, or pulled forward the emissions to
make it a dynamic
more
system.
sooner, and make it dynamic. So it would be that narrowly failed, right? What was it needed 66 0.66 repeating.
I think they got 62. I can't
close.
remember the numbers. It was close.
But you guys operate one of the largest Solana validators, and at the time it might have been first or second, I think, during that vote. And we were like trying to count votes. It was like whip counting, right? Like it's like in Congress. How did you guys? I liked the way you guys ended up handling it as a service provider to those who delegate to your node.
Yep.
Talk about how you did that.
Yeah, I mean,
what you did.
First and foremost, it was the most out of any new proposal that we've seen in any network. It was the most talked about, the most active across the community, and probably most whipped. Voting.
People were calling around, doing spaces, and
we frankly floated. In Solana as a validator governance model, right? But we talked a lot internally around what was the right methodology, and so we also went out to our stakers, and we had the whole sales team and everybody going out to our known counterparties and asking what their votes for, and we voted with our counterparties. And obviously Galaxy has its own Solana position, and so we voted based on our internal governance committee.
Right.
So it was a pretty democratic process and system. It took a lot of time.
Yeah.
But I thought it was really good showing of how governance should and could work. Now, I know that there was people in the industry that weren't really happy that it failed, but it was great that you got like real active participation, and every validator handled it differently.
Yeah,
which is interesting. I think a few followed us.
Yep.
But others might have just voted their stake because they have that right as a validator.
Yeah.
And so it was a fun, I think, incredible process. And let's not. I would like to again emphasize the fact that the whole Solana community was so deeply engaged over the course of however many weeks. It was an incredible, just groundswell of activity, and I think that just shows the commitment of that ecosystem to getting it right. Ultimately, it did not pass, but that does not preclude other similar SIMDs coming forward that would take another stab at reimagining the inflation schedule. But and we talked a little bit about this earlier, but if we assume for a second that this is the institutional staking moment, and that all these massive asset managers, et cetera, are going to be coming in pretty substantial size that we haven't seen before, if we all do our jobs properly, then that's a ton of stake weight that really should be participating in on-chain governance as well. So what we did was, what we thought was the most sensible thing to do. But our hope is that our democratic process could be extended to or adopted by those who are going to be coming in, also commanding their own syndicates of stakers, and really these are the investors in their core, total return or staked Solana or ETF products.
You could imagine Invesco emailing a proxy statement to every maybe
not
every
that's essentially
time.
what we did.
Right.
That's
it is
essentially
what
we did. Yeah. There was a proxy vote.
It's really quite interesting.
Yeah.
This is going to force, you're right, it is going to force the staking in the ETFs in particular. Because the ETFs on Ethereum, right, you've got Fidelity and Invesco and Blackrock and Van Eck and CoinShares and others, right? Surely it looks like you'll have the same for Solana as well, pretty much the same pedigree. They're all going to have to figure this out all of a sudden. It's one thing to just buy coins and hold them in a custodian. Most of them just at Coinbase, right? Fidelity themselves, but okay, that was a big step to your point, spot. Right, but once you start being we actually have to interact with this thing. It can't just sit there in our vault forever.
Yeah. And there's the economics that people,
Yeah, and that's the thing. Will there even be total return, or why would you even want a non-staked ETF? Wouldn't it? They'll all be total return, probably, right?
Yeah, I mean, there's some case to be made that there's no, it's in a non-risk. There's risk associated with staking, but by network, right? There's slashing considerations, and Ethereum has its complexities.
Entry, execute stuff. And
It's very dynamic. Solana has no slashing today. But yeah, like we spend a lot of time with, educating. The TradFi institutions are getting up to speed. What is staking?
Yeah.
What are the risks that I'm taking? The chief risk officers, the compliance folks, they have to underwrite these positions for their institutions, and so there's a lot of education that is happening in this space. And then the other thing is that I think is an under discussed piece of this is slashing insurance. The slashing insurance market is pretty immature today, and I think you'll see a lot of growth in that space. And that's really just because the underwriters don't have the technical knowledge to really underwrite the risk. And I think we're seeing a lot more maturity coming into the space, a lot more sophisticated insurance providers saying, all right, this is an underserved market, and how do I serve that market? And so that's the other dynamic here that the Invescos and whatnot are all talking about. We're talking about with them as well.
Yeah, they definitely have to figure that out. Yeah. So, a couple more questions here before we wrap. I think I wanted to ask you guys to maybe just tell your background for the audience here. I should have asked you this at the beginning, but this is a new industry. I mean, crypto is still pretty new, but staking is, at scale, like I would basically say since Solana, maybe since the merge even, which is a year or two after Solana. I mean, it's 2025. The merge was in fall 22. So you're maybe talking about like at the scale, close to the scale we're at now, 3 years. How does one get into this business? How did you find yourselves? You both have interesting paths here.
Sure.
Go for it.
I'll go first.
Yeah.
So I actually started my career in TradFi, like a lot of people at Galaxy.
I explained this to somebody recently. I was like, we call you. I was talking to some
we
guys
call
at
you
Goldman.
TradFi.
I was like, you are TradFi. They're like, what is that? I was like, traditional finance. That's what we call you.
Yeah.
I was like, we and like probably a couple million other people online call you all TradFi. Sorry.
I've had that conversation.
It's finance.
It's pretty funny. They don't even know.
Trad finance. So derivatives junkie, basically. Before joining Galaxy about 4 years ago, I was on the derivatives desk at Credit Suisse on the private side, covering corporate clients. So really, the way that I attack all these conversations is through the lens of how a treasurer or CFO would think about risk to a balance sheet, being sensible in deploying different products and services so as to generate return on balances, but also manage risk, et cetera. And so when I joined here 4 years ago, worked with you and Kareem and Amanda and all the other mining guys, talked to the miners about risk to their balance sheet, thinking about collar strategies and stuff like that, because that's the world I came from, and an exploration of basically going around to the actual traditional corporates, which were the miners at the time, lends itself to an exploration of the pseudo corporates of Web3, which are like these foundations and these protocols themselves. And so the development of staking and this outfit that we run really was a byproduct of how can Galaxy also add value at an infrastructure level, which is a nice complement to our existing full suite of financial products to help treasurers and treasuries around the Web3 space.
Cool.
Off to Harry.
Yeah, I was at KPMG for a long time before I came to Galaxy, and I was focused on I was in risk consulting, and I was helping companies go from private to public. I was mostly private equity hedge funds that were either spinning off companies, and you'd go and do all the regulatory middle and back office transitioning. Came to Galaxy to actually do the same thing here, right? As head of enterprise risk, and I had a moment where Galaxy was trying to go on chain, right? And I helped build the risk framework, and then that just snowballed into me being
now we are on chain.
Meaningfully on chain, right? And so I was on that. I was like one of the founding team to help Galaxy move on chain, and that just snowballed into the on chain trading team, and then joined Zane about 3 years ago at this point. And now it seems like we're doing a ton on chain across blockchain infrastructure trading, and I think it's really exciting space. I mean, we didn't spend too much time on it, but like what is the future of blockchain infrastructure and markets? I mean, like validators and Solana are basically the market.
Yeah,
right?
part of the capital markets. We
Exactly.
Think. I mean, we do think that they are going to allow tokenized equities,
Yeah.
and I don't even like the term. They could be natively issued on chain, so they might not be tokenized. They might just be equities on chain.
That's also very interesting to me too, because you have an off-chain ledger and then an on-chain, a wrapped asset.
Right.
Hopefully you get to the place where you don't even need to do that reconciliation
Right.
between the two and you just issue on chain
Right.
and there is no books and records.
Right. We talk about this a lot. Like transfer agent manages the books and
Yeah.
records of an equity security, and it's like you could just like marry the KYC of the token holders just with blockchain data. You don't really need that entity. We're not quite there yet.
That will take some time to get everyone comfortable.
Yeah. Zane, you alluded to this a bit, both of you have. Talk to me about how Galaxy uses blockchain infrastructure as part of like a full stack sale, whether it's to investors or protocols. Like, what part do you guys play in selling the entire firm?
I would say we're at the center of it. No, I mean, practically speaking, I mean, think about it. What's so cool about our jobs, and why I frankly love the seat, is we've got the crypto native side where think of it as like a protocol starter pack, right? We've got an awesome ventures team. We've got people as part of the ventures platform. We also have like in-house advisory and product studio type development capabilities. Bootstrapping a protocol from pre-seed, seed, Series A stages to full development and maturation involves hopefully a steady hand in an institutional infrastructure provider to help them with testnet all the way through mainnet, et cetera. And so there's a lot of value, hopefully accretion to the Portco complex that are very early along in their stages. And at the same time, we've got a full suite of traditional financial structures, excellent OTC trading, lending, derivatives capabilities, and also staking capabilities. And what's been our unique wedge in our value proposition to a lot of the institutions that we're speaking to now are, one, we come from their worlds, we understand them deeply, their risk parameters and all kinds of other stuff. But number two, we as a unified Galaxy can offer unique financial structures that contemplate the use of staking technology as well. Staked assets as collateral, for example, for better capital efficiency within our trading confines. The instant liquidity product we were talking about for ETF and ETP. So, in any other instance, maybe, pure play blockchain infrastructure is kind of like a great service on its own, but it's that much more powerful when it's wrapped around the combination of all these other amazing operating businesses we have at Galaxy. I know that sounded a little bit salesy, but it works. Like truly, it works.
Yeah, I was just going to say, not to sound like we're too salesy here, but I don't know of another firm that can go from is along the entire life cycle of a protocol launching from 0 to 100, and we have services across all of it. And I mean, I think Zane said it really well.
All right, well, gentlemen, this has been great. A long time coming. The group that you guys call the Bash Brothers.
The Bash Brothers.
I don't know if we're dating ourselves. I don't think people know Mighty Ducks. But Harry Austin and Zane Glauber from Galaxy Strategic Opportunities team, thank you so much.
Thanks for having us, dude.
That's it for this week's episode of Galaxy Brains. Thank you to our guests, Zane Glauber and Harry Austin from Galaxy Strategic Operations and Blockchain Infrastructure team, and our friend Beimnet Abebe from Galaxy Trading. As always, everyone have a safe and happy weekend, and we will see you next week. Thanks for listening to Galaxy Brains, the weekly podcast from Galaxy Research. If you enjoy the show, please like, rate, review, and subscribe wherever you get your podcasts. To follow Galaxy Research, sign up for our weekly newsletter at gdr.email, read our content at galaxy.com/research, and follow us on Twitter at GLXY Research. See you next week.